Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Claudia Sahm on fire with us a few days ago, and she has written up a storm of brilliance. We're thrilled that she could join us. Some New Century Advisors, her definitive work at the Fed and at Michigan as well. Claudia, of all your charts, to me, the most emotional one is, unlike past expansions, the unemployment rate is rising. Are we in an expansion, or are you on the acclaimed Sahm recession watch?
No, I mean, we are in an expansion. It's very unusual to have a jobless expansion at this point. And a gradual rise in the unemployment rate is still a rise in the unemployment rate. It is a problem for some workers, but it doesn't, the economy does not have right now that kind of recessionary dynamic, those rapid increases in the unemployment rate. And it's been a feature of the economy for 2.5 years now that we've seen this. So it's very unusual.
So, Claudia, if we do have an economy that is growing, but a workforce that is not necessarily growing along with it, does that mean we're more productive?
Not necessarily. I mean, the low hire, or maybe we'll see today, no hire economy, that is really rough on people coming into the labor market for the first time, or maybe coming back into the labor market. They are really facing a tough labor market, and that loses all kinds of potential, particularly for people at the beginning of their career to get off on the wrong foot. We're seeing a lot less movement of people from jobs to jobs. So maybe that makes them more productive because they've been on the job longer, but I wouldn't, maybe frame it quite that way.
Dr. Sahm will be with us after the report. Let me squeeze this in, Claudia, if I could. You've got a brilliant 3-month moving average chart, which is the way I roll. In the negative integrand, this is calculus talk, Paul, stay with me here. The negative integrand is late spring last year. We're basically on revision, potentially into negative non-farm payrolls back to when the Red Sox were going to win last year. Is it that grim? We've really been that soggy since April of last year?
Yeah, I mean, job creation really hit a wall. Now, we can argue about whether it's grim in terms of how worried we should be about this, because, again, the unemployment rate has been rising only gradually, not dramatically. But yeah, no, I mean, and we could see that last year when all the dust settles with the revisions, that no jobs were on net created in the U.S., and that is very unusual outside of a recession.
So we're going to have that one-time kind of, payrolls revision here. Explain to us what that means.
Right. Well, every month when we get the jobs day numbers, these are based on a survey of businesses. I mean, it's a large survey, but it's not all the businesses in the country. So once a year at the benchmark revision, the Bureau of Labor Statistics uses what's administrative data unemployment insurance system, which is basically a census of the 11 million establishments in the country. And so then we true up the level of employment, because the survey just isn't, it can miss things the first time around. I mean, there's a lot one can say about this, but really these revisions, they're probably going to be big today, but it's a sign of us getting better quality data so we can have this conversation about what is going on in this labor market.
Claudia Sahm, stay with us again. Commercial free for you across this nation. Diane Swonk and Eric Winograd later. Carl Weinberg in the 9 o'clock hour. Jurrien Timmer of Fidelity will join us in the 9 o'clock hour as well. Where are we in the last 5 minutes? Futures lift a little bit, up 3 now, up 11. Don't want to make a big deal about it. VIX comes in nicely, 17.85. The yields for those keeping score, keep your hands on the wheel. For those driving, 4.12%. Yields are in a solid 2 basis points. Price up, yield down into this jobs report, and the dollar fractionally weaker. It is time to look at the labor economy.
This is what we've been waiting for. January jobs figures and the change in non-farm payrolls much stronger than expected. 130,000 jobs added to the economy last month. The whisper number was for 35,000. We've got the unemployment rate ticking down to 4.3%. 4.4% was expected. And the big one, the final benchmark payrolls revision, we're still waiting on that. There was an expectation for a loss of 825,000 jobs. Want to look at average hourly earnings month over month, up 0.4% year over year, right in line with estimates, 3.7%. The market reaction, not much. We've got S&P, Dow, and NASDAQ futures, little changed following this report. Again, the economy adding many more jobs than expected last month, 130,000. The expectation was for 65,000, guys.
Thanks so much, Alexis. Really appreciate that. We were up 11 on futures, now up 20 as well. A nice lift to the market. NASDAQ up 0.6%. VIX comes in as you'd expect. Paul, the yield space, what do you see?
I'm seeing a big movement in U.S. Treasuries. Exactly right. Look at the short end of the curve. The 2 years up 9 basis points, 3.54%. So a big move there. The 10-year up about 4.5 basis points, 4.19%. So the short end of the curve, Tom, really reflecting this better than expected non-farm payroll.
Higher yields and price down across the entire spectrum of debt. The 10-year real yield was a 1.80, now out at 1.85. I want to two-part this discussion to go back to Dr. Sahm. Major shout out, Andrew Hollenhorst, Citigroup, just nailed this thing. We're going to try to get Dr. Hollenhorst on the phone. You know, I look, Claudia, at a 130 number, but with a negative revision. I don't want to oversell it. You need a 3-month moving average, as you say. Non-farm payrolls, 3-month moving average, 73,000 is our first quick look at Bloomberg. But then I've got the actual final benchmark revisions rounded up, almost negative 900,000. Translate a negative 862,000 revision.
Well, and I'll say the benchmark revision that goes to last March was almost 900,000 down. There are other revisions from the birth-death model that come in the months after that. By December of last year, the downward revision was over 1 million jobs.
Yeah.
So now we got the best possible outcome today. We knew these revisions were coming, and again, we can talk about what's behind them, but to see the most recent readings, we've got some lift in the payrolls in January. It's just 1 month, but we got some lift, and the unemployment rate ticked down. So we want to see a labor market that's stabilizing and coming out of this, but these are huge revisions.
Dr. Sahm, I'm sitting in the back of the class at Michigan hiding. You and the smart people are up front. Okay, my fancy math is 1 million jobs lost for whatever Claudia Sahm, Diane Swonk reason, divided by 12 is 83,333 jobs evaporated every 30 days out of our belief, our fabric of the American labor economy. Do I have that right?
So the revisions actually go back further. The first month that will be revised down because the benchmark was April of 2024, right? They take the annual benchmark revision is wedged in over the prior 12 months. So we're that million down, that's happening over a span of time. But if you look at the monthly changes last year, the new estimates, there's a lot of red. I mean, there's a lot of months where we were dipping, into the not, destroying jobs. So these are big numbers. It is spread out over a period of time, but there's something here for us to understand about what exactly is happening with job creation and how comforted should we be by the latest numbers. Have we turned the corner, or is that just an aberration and we're going to get back into these really low numbers?
How do you think the Fed is going to react to these numbers, Claudia? Again, the change in non-farm payrolls coming in for the month of January, much better than expected.
Yeah, so the Fed knew about this. The Bureau of Labor Statistics published its preliminary estimate of the benchmark revision back in September. It was for a negative 900,000. My goodness, it was almost, right on the money. And this is certainly, you've heard Fed Governor Waller mention this in his dissent, but also Fed Chair Powell talked about, revision. So these numbers aren't surprising. I mean, really the news today, maybe the most recent months, the January, again, not to overplay it, but it's good news to see that kind of number and the unemployment rate ticking down. So this is not a surprise to the Fed. Right, we knew this was going to be in the data.
But you published a chart last night, folks. It was in English, unlike anything I would do. And Claudia Sahm, I mean, you said within the dynamics of the labor economy, that the dearth of immigration plays into this. I mean, your chart's a little spike up, a little line up. Are we at 4.3% because of immigration dynamics where we ought to be at, say, 5.3%?
So I think the immigration dynamics, and we've seen a big swing, a lot more immigration than had been typical, and then a big slowdown in immigration. That certainly is important in understanding what is up with these jobs numbers that just really hit a wall. So but it is not the only factor behind it. Like, we have still seen the unemployment rate drift up. We are not, like, labor demand for workers is not keeping up with the supply of workers, right? But so the unemployment rate is giving us a much better picture of this kind of gradual problem that's building. The payrolls, because it has the supply of workers has just shifted so abruptly. The message from the payrolls looks a lot scarier than it is, but I don't want to write it off. Right. Like, we still see wage growth slowing, unemployment rate drifting up. And certainly for groups like, people new to the labor market, this is a very tough job market.
Tough job market. Just real quickly, that 862,000 final benchmark revision, just put that into context for us.
It's big.
Yeah.
It should be about 0.6 of total payroll employment, something like that, 5/6.
Right.
And before last year, a typical had been more like 1/10 of the level. Last year's was pretty big too. So, the average over the last 10 years has been about 2/10. So this is like 3 times larger. And we've had 2 of these in a row. And again, I want to stress, this is not a sign the Bureau of Labor Statistics is asleep at the wheel. This is just, we have some major dynamics happening in the economy, and it's really tough to measure them in real time. And so we're kind of catching up, and it should help then with, people trying to understand the labor market. Still a lot of puzzles, but we've got better data today. And that is a really good starting point for understanding where we're going and what policymakers might want to do.
So, Claudia, help me here. Folks, Diane Swonk coming up, and Eric Winograd here in a moment with AllianceBernstein. So Eric Winograd's up at Dartmouth, freezing, unlike the cushy Ann Arbor weather. Claudia Sahm, he's taken the 7s. He's taken labor economics. Is this your brilliance, Claudia, out on Twitter last night? The academics right now of our labor economics. Is this in the textbooks Eric Winograd studied?
I mean, every recession has its own dynamics, but ever since the pandemic showed up, the labor market has been doing things that are just unusual, if nothing else, in their magnitudes. We've just had some really abrupt swings. And so, I think this business cycle really does stand out. Right. And but it may stand out in good ways. Maybe that gradual rise in the unemployment rate without a recession, maybe that's what a soft landing actually looks like. Like, we don't ever get those. So this doesn't have to be a bad news story, but there's certainly tensions. And I just want people to remember, just because we avoid a recession doesn't mean it's good enough.
She's, we lost 1 million jobs in some understand. And she's telling us it's not a bad news. Sorry, Claudia, can you stay for 5 more minutes?
Of course.
Okay, thank you so much. Joining us now, Eric Winograd with Claudia Sahm. I think that the 2 of them, Eric has a much more international feel, maybe, but the 2 of them are the market economics at AllianceBernstein of Eric Winograd with the academics of Dr. Sahm. I think it really dovetails here. Eric, how do you translate Claudia Sahm's brilliant work on the labor economy? Not on recession, but she's been on fire the last 24 hours about these odd Newtonian dynamics of our labor economy.
It is a very strange economy. And to answer the question that you asked, no, none of this was in the textbooks that I was looking at Dartmouth. But I think you want to put this in perspective. You just said a minute ago, Tom, we've lost 862,000 jobs as a result of this revision. That's not true. Nobody has lost a job. We're just counting it better, right? So that it is not the case that people lost jobs. It's just that the data has been improved.
But the jobs we counted weren't there.
That's correct. But again, what are we really interested in? Are we interested in the statistical minutia, or are we interested in the way that people in the economy experience this?
Sounds like Claudia.
We're more interested in the way people experience this, and nobody actually lost their job. I agree with Claudia 100% that the true signal in today's report is the unemployment rate. Because the revisions to the headline series are so complicated, they're a statistical artifact. The unemployment rate is balancing supply and demand in the economy, and it's telling us that things are okay. Not great, but okay.
Does it reaffirm, Dr. Sahm, the idea of 2 rate cuts? I mean, how do you go to 4 rate cuts with a 4.3% unemployment rate?
My base case is still 2 rate cuts this year, but we're going to get a lot more information, and the Fed is going to watch the labor market extremely carefully in terms of how they adjust going forward.
Eric, how do you think AI is impacting this labor force here? Because people say it's really tough to get a job, and maybe that's the entry-level job, and maybe that's the job that's being impacted by AI, at least initially. Does that factor into your work at all?
So it's just one of the ways in which this labor market is confusing and complicated. And I would actually refer you to a speech that the governor of the Bank of Canada made last week, Tiff Macklin, where he said that if part of the reason the labor market is so tough is because of these structural changes, because of artificial intelligence, for example, it isn't appropriate for central banks to respond to that by cutting interest rates. You can't boost labor demand with interest rates if the problem is AI. I think it's premature to draw that conclusion. Claudia has said, and she's right, that there is some evidence that entry-level workers in particular are struggling.
Right.
But we're still very, very early days on this.
One final question, Claudia Sams. I know you have to publish for New Century. Claudia, I want you to speak to the huge body of the nation that's not worried about their stock options on a Mag 7 equity holding. They're not part of the profit machine of technology in America. How flat on their back is the rest of America?
Right. Well, for that group of Americans, I mean, their jobs are so critical to their well-being. And for people who have a job and like their job right now, things are really pretty good. Right. Wages aren't, going gangbusters. Workers are not sharing in all of this productivity that seems to be out there necessarily, but it's pretty okay. But it's the ones who are on the margins, who don't have the job or want to switch job, they are a lot more stuck right now. And so I think really the labor market, it has always been and will continue to be central to people, particularly those who are not plugged into the asset markets.
Claudia Sahm, thank you for your commitment to Bloomberg surveillance. Dr. Sahm is with New Century Advisors. I can't say enough about her work out on Twitter and LinkedIn, just hugely informed. Stay with us. More from Bloomberg surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So when you get this huge report coming up and you get the data, what do you do? Well, to impress Lisa Shalett, I go to the 10-year real yield, which is sitting at 2 standard deviations under 1.81%. A breakdown there in the 10-year real yield would be a big deal. And then she knows I go to Swiss franc.
No, who doesn't?
That's what you do at Morgan Stanley. And I'm sorry, I got Swiss franc at the cusp, along with yen, a 153.59. Joining us now, Lisa Shalett at Morgan Stanley, probably on a plane heading for Tokyo here at some point. Chief Investment Officer, Morgan Stanley. Let me cut to the chase.
Yes, sir.
Brad Hintz.
My old buddy.
Is AI going to replace Brad Hintz?
So look, absolutely not. What I can tell you is that like every other technology, we fundamentally believe that AI is an enabling tool. It is an enabling tool for expertise. While there are many things that we do that can be automated in terms of a process, that are repetitive, that require us to capture and intake information and summarize it, the real beauty of expertise is creativity and interpretation. And as far as I can tell, at least thus far, my interactions with the technology is that we're far, far, far away from being able to rival an analyst, a human beings.
It's tough to see because we saw in just this year, last several weeks, last couple of months, this AI story's evolved a little bit from just how much can we spend to how big can it get to be, who's at risk from the deployment of AI technology. And then over the last several weeks, it really hit a lot of these software companies.
Yeah. So the software sell-off, on one level, doesn't surprise me in the sense that some of these business models are ultimately, going to be disrupted. But what I think people have to remember is a lot of the enterprise software companies in particular, what they have done with companies is they've come to dominate, organize, optimize data.
Yep.
And, where we are in terms of AI implementation in most companies is you need the data. You can't train these tools to do anything without the data. And I think it's going to be really hard to do it without some of these enterprise software companies participating in a major way.
So 2025 was a solid year for U.S. equity investors, solid returns in the fixed income market here. I don't know, what's the call here for 26? Are we more of the same? What are you looking for?
So, look, I think our tagline for 2026 was simply, price to perfection, which means the window for upside surprise is narrower. So our view is, this will be a good, solid average year in stock markets. That means 7 to 10% total returns. But it's going to be a little bit more vol. It's going to be a little bit more idiosyncratic. It's going to be about fundamentals. It's going to be about earnings, achievement, and surprise. And that stuff's hard.
Lisa Shalett with us with Morgan Stanley. And this is breaking news, and it's absolutely perfect for Ms. Shalett with all of her decades of work, of working out companies, of deciding what not to own. All the focus, and I'm as guilty of this, Lisa, as anyone else, is on 12 stocks. I'm an idiot. And what I'm fascinated by is the rest of corporate America left behind that's not getting it done. Kraft Heinz, Kool-Aid, Jell-O. I think they own Velveeta. I can't remember. They're going to stop with their split into two publicly traded companies. Organic revenue last quarter was a stunning -4%. I'm going to put that 700 beeps, 800 beeps behind nominal GDP. Well, how should our listeners and viewers interpret companies, big blue chip companies that just aren't getting it done?
Yeah, I think that you've got to be come to them with an extraordinarily critical eye and ask yourself why. For a lot of the consumer staples companies, they have been, the victims of, currency movements. They've been a victim of some of the, consumer impacted tariff related issues. And they've been, victims of demographic and behavioral shifts in terms of how much staples are actually consumed at home.
And in a portfolio, you just say no, right?
Yes.
You just don't own it, right?
Exactly. You got to go through name by name by name and make an active decision.
Right.
Am I overweight, underweight, or no weight?
Brilliant. Paul, the PE of Kraft Heinz, 9.
Yep.
It's trading like international paper years ago. The dividend, talk about a broken dividend on the Bloomberg, I got 6.42%
dividend yield. So you're living for the dividend, I guess.
Yeah.
Lisa, Morgan Stanley Wealth Management, how much alternative assets do your clients want to own? What's an allocation there? Because I'm always shocked that it's much higher than I would have thought.
Yeah. So our recommendations, and I sit atop our global investment committee, which derives this asset allocation advice. We've routinely, talked about truly private illiquids at roughly, 10 to 15% of your portfolio. Hedge funds maybe at 10. So you think about just those two categories, you could get as high as 25 for an ultra high net worth client. Now, that's very aspirational. It's very theoretical. It's Harry Markowitz and efficient, frontiers and the like. The reality is that today within, the Morgan Stanley Wealth Management book, the penetration, the actual average allocation to alternatives is much closer to 5 or 6% than that 25% recommendation. So a long way to go.
How about fixed income? I mean, now you could be clipping some nice coupons. I'm not sure we're going to get price appreciation like we did last year, but is it okay to just sit there with a nice diversified fixed income portfolio and clip coupons today?
Yes, absolutely. But you want to be very careful about where on the curve you are. We expect there to still be some front-end volatility and those rates to come down. And on the long end, we think that there's still a bias higher to rates. And because of the long duration, that could produce some volatility. So we're focusing on what we call the belly of the curve, or somewhere between 4 and 7 years of duration, to truly have just clip coupon. Don't get too aspirational about what you're going to make on price. Just try to focus on the coupon clip. But in the rest of fixed income, credit has become extraordinarily richly valued. Yep. And so there we're applying a similar lens to the one we're applying to stocks, which is let's start being a little bit more discriminatory and decide, do all of these bonds, deserve these tight spreads?
Lucky you, I got 20 seconds. Did we place the 100-year Google yesterday into Morgan Stanley portfolios?
That I don't know, Tom. I don't know where we were on the tear sheet when all is said and done. But it's an extraordinary moment, and you know this from prior bull market cycles. When you see these 100-year type of events, they tend to get marked on the
I could just see you walking into the interns at Morgan Stanley, the gifted few chosen to sit in the class. You go in with a piece of chalk and you put perpetuity up on the chalkboard and say, "Read it and weep." Lisa, thank you. Lisa Shalett with us, Morgan Stanley Wealth Management here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Her leadership at the National Association for Business Economics is noted with KPMG. Diane Swonk joins us right now. Diane, just a 60,000-foot question for our listeners, those with a job, those with Google stock options and the Google 100-year piece, and those flat on their back across America. How K-shaped are we this morning?
Well, we are as much as we've been since the data started on corporate profit share versus wage share in the economy going back to the 1970s. What we're seeing is a record break between the share of profits going to wealth holders versus the amount of going to wages. And I think that's where the bulk of this is. You're seeing the productivity gains accrue to the owners of capital as opposed to workers, and that's why workers are not very happy about where things are. Also, when you think about wages, I think it's very important to understand that we are seeing this labor market looks like it's now healing after getting cratered last year. That's important, but it's healing at a pace, as Claudia and Eric pointed out, where we just don't need to generate many jobs to be able to bring the unemployment rate down, which could push wages higher. That's great if it does not also be accompanied by inflation. And we know that much like stock returns compound, also inflation compounded over the last 5 years, leaving too many prices out of reach for too many.
Paul, I was just going to say for your weekend reading, it's not Friday, it's Wednesday.
I know. We got a ways to go. Tom, a red headline crossing the Bloomberg terminal. Traders fully price in Fed rate cut by July versus June previously. So the WIRP function we're seeing it right there here on this strong labor print. Diane, we know the Fed likes to look at this unemployment rate, and boy, it ticked down from 4.4% to 4.3%. That's fully employed America, isn't it?
Actually, it's even better under the hood. What we saw was the U6 rate, which is that sort of underemployment rate where you get discouraged workers and those having to cut part-time for economic reasons. That fell to 8% from 8.4% in December. That's an important move. It's still well above the 6.2% we saw back in 2019, but it is a move down, and an important move down for those who were really struggling to get a job. What we're starting to see is some of the ice melt in the labor market now, and things beginning to shift a bit. We need to keep up that momentum for workers. On the flip side of it, it keeps the Fed on the sidelines longer.
We're not seeing, what this labor economy has been described as a, kind of a low hire, low fire type of environment. How about some of the industries that rely historically upon immigration, such as housing, agriculture? Are we seeing any problems there?
Well, we are seeing a major shift in things like leisure and hospitality in terms of quit rates. Quit rates in that sector have soared even as they've cooled and sort of come to a near standstill across the economy. In the job openings and labor turnover survey, we saw those quit rates really soar. That has not been accompanied by a lot of wage pressures in the economy that was very weak last year. And in fact, vacations actually went down a bit over the course of the year. We saw only the affluent households households continuing to spend heavily on vacations. And that showed up in the breakdown in terms of people paying to go to the front of the bus, in terms of the planes, and luxury hotels continue to do extremely well. But the rest of the economy side of vacations did not in 2025.
That binging you here, folks, I believe is Dr. Swonk. That's Kevin Warsh singing Diane Swonk right now.
Yeah.
Like Kevin Warsh is saying to Diane, we need to talk right now. Diane, one of the things here, and I'll pick on a city that I know is really having trouble. Alexander County, Illinois, 6% unemployment rate. This is Cairo. It's southern Illinois has really struggled. How do you synthesize, Diane, with all your decades of work, the easy gloom path versus observing the vibrancy of the American economy? I mean, the media and Tom Keene are really, really good at going out and finding a 6% unemployment rate and saying, OMG, the world's going to end. But there's an America that's vital out there. How do you balance that after this report?
Well, I think the important issue is that we know that fewer firms and fewer households are accounting for more of the economic gains in the U.S. economy. And that's where you get to the K-shaped economy. We've talked about it a lot, but it's showing up in just about everywhere in every strata, even with higher income households now trading down and going to big box discounters, trying to get more value because they're feeling strained as well, unless they have a large stock portfolio. So there really is this delineating thread that goes through the U.S. economy in terms of wealth versus non-wealth. And it's not just housing market wealth. Equity in your home cannot be as easily tapped, but wealth in the stock market has moved up dramatically. And that is important because it's not filtering down to workers. And the dichotomy of those two things happening at the same time, the hard part is that it keeps inflation buoyed as well. And I think that's something that the Fed is going to be watching for. And we know that, as you heard earlier, I think Eric pointed it out, if these losses that we saw in jobs last year were more structural than cyclical in nature, then rate cuts don't help them. If they are more demand-driven and the rate cuts actually help to reignite employment, that's great, although they don't usually work quite this quickly. So I have my doubts about that. I think we are working through some big uncertainty issues that finally abated a bit, but measures of uncertainty moved back up again in the month of January.
Diane Swonk, thank you for your work. Diane Swonk is within KPMG here. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
This is an honor. I'm going to explain this as carefully as I can. Fidelity was very, very kind to me over the years. And one day I was at the old building, up a number of floors, just past where they keep the Red Sox tickets. And there's a circular room with cloth walls, and on it, with perfect MIT pins, is the chart room. Jurrien Timmer this week put out the chart.
These charts are out of hand
of the
here.
Dow Jones Industrial Average at 50,000. I've been waiting to talk about this to get to Jurrien Timmer, Director of Global Macro at Fidelity. Jurrien, is it responsible to extrapolate the bull market trend that we are in out to 60,000, or dare I say out to 100,000 Dow points?
Well, good morning. Well, certainly that chart will show you that it is safe to extrapolate because, just like life, growth is, it happens, but sometimes it happens slowly, sometimes it happens quickly. So we will get there eventually, but, the Dow can spend many years at one of these milestones, or it could spend literally a minute before it goes to the next one. And this one, of course, we are in year, at least by my estimation, we are in year 17 of a secular bull market, and the milestones come fast and furious during secular bull markets, and they come very slowly during secular bear markets. And so I think the drivers of this secular bull are still intact, but it is long in the tooth. They generally don't last more than 18, 19 years or so. So we do have to keep an eye on the clock in that sense. But it's, I found it very pleasing last week that when we're worried about the SaaS stocks getting, commoditized because of AI programs and, are the hyperscalers overspending on CapEx, that very quietly the Dow just ended the week at a very major milestone. So it's nice to see that the market is broadening, and it's doing so in the best way possible, which is not as a zero sum, where the Mag 7, fall from grace and drag the index down, even though most stocks are going up, but in a way where the pie actually gets bigger. Now, we'll have to see if it lasts, but it's a win for now.
We've seen, I guess, a rotation over the last 3, 4, 5 months, maybe a little bit of rotation out of some of those high growth, high multiple tech stocks, maybe a little Mag 7 into more cyclical sectors, maybe even some small and mid cap. Is that a longer term trade? Is that a short term trade? How are you thinking about that?
I think it's a longer term trade, right? So if you line up a bunch of pairs trades, growth versus value, large versus small, U.S. versus international, financial versus hard assets, like commodities in general, they all follow like a 30-year cycle, like a very long wave, almost like a Kondratiev wave type of formation. And on a 10-year rate of change basis, a CAGR basis, all of those pairs trades have been sort of waiting in the wings from a duration and a magnitude perspective. And we're just waiting for the catalyst, right? So as long as the Mag 7 are dominating, all those pair trades have to sort of wait. But one by one, they're springing to life, right? International is now outperforming U.S., which is very nice to see, because we want the market to be as broad as possible, right? We want to fish from the biggest pond possible. Commodities are moving, and like you said, even small and mid caps are now starting to wake up. And so I do think that once that happens, it's a long-term trend. That's like a 5-year plus strategic allocation type of plan. The question is, again, does it come it always comes at the expense of growth, but does it come at the expense of the beta that the growth sector produces? And if that's the case, we're going to have less beta, but more alpha. But that, to me, is the big question.
Jurrien Timmer with us, folks, to help us get smarter with Fidelity or Carl Weinberg later on in the hour. We welcome all of you around the world on YouTube. Subscribe to Bloomberg Podcast. Sweeney and I shaking down the new Bloomberg Hub.
Yeah.
A set of videos here out at Bloomberg.com. Look for that, building out each and every day. And, of course, the way you listen to us, special good morning to 92.9 FM in Boston, land of Fidelity and Jurrien Timmer. Jurrien, which of your wonderful charts that you give us on LinkedIn and to all of Fidelity, which chart's the most informative for people in their 401ks? They're in equities. They believe in the American experiment. Which is the chart that matters most?
I think there's so many, but the one that explains the market's lofty valuations, right? So we all spend a lot of time on okay, the U.S. stocks are so expensive, 32x 5-year CAPE ratio, 25 times trailing earnings. But you have to take that into context, right? If you regress those PEs or equity risk premia against where investment grade or high yield credit spreads are and where operating margins are for the S&P 500, they actually make sense, right? So, the market's not stupid. It's not going to price itself at a level that doesn't make sense. It's very efficient. And so if you think equities are very expensive or too expensive, or even in a bubble, which I don't think they are, then by definition, you have to think, in my view, that credit spreads are too low and are going to rise, and margins are too high and are going to fall. Otherwise, equities are just pricing in the same fundamental scenario that all the other markets are pricing in. And so I think that's an important thing to keep in mind, because it's easy after a long uptrend, and the cyclical bull is now 40 months old, the secular bull is now 17 years old, to say, I'm afraid of what comes next, so I'm going to get out. But if you get out, you're not going to compound. And that's a major drawback. So looking at the market holistically and look at why valuations are where they are, what do they assume, I think is an important piece of context. Otherwise, it's easy just to say, oh my God, we're in a bubble, I'm going to run for the hills.
You're in 2025 and in year to date so far in 2026, the U.S. equity market's doing just fine, but rest of the world doing a lot better than fine, outperforming the U.S. Talk to us about U.S. versus rest of the world these days. What's your view?
Yeah, it's a really great story. It happened last year, of course, during sort of the tariff tantrum. But what's happening is that the global economy is waking up. We all know the story from a year ago with NATO having to pull its own weight and seeing more of a fiscal impulse in Europe. And of course, in Japan, we're seeing that, commodities are becoming a national security type of resource. So in a fragmented multipolar world, I think commodities become a strategic asset. And so then you look at commodity-centric countries, mostly in emerging markets, that are now being competitive. So when I divide the world into developed and emerging, so IFA versus EM, they both have interesting stories, right? IFA, the companies in Japan and Europe are becoming much more shareholder savvy. They're unlocking or monetizing their balance sheets and by buying back shares in order to reward shareholders with a higher payout ratio. And it's interesting that the payout, so dividends plus buybacks, is rising faster on a 5-year basis in both Europe and EM than it is in US, which is maybe counterintuitive because in the US you figure Max 7 are the engines for that story. But the payouts are competitive, the payout ratios are competitive, yet they trade at a 15 PE as opposed to a 22 PE. And that's, so, it's easy to fall into a value trap, but once you have the value plus a fundamental catalyst, boy, you got some magic, and that's what we're seeing over there.
Okay, I got to ask. Paul was just on Aruba, and he's decided to move there. Jurrien Timmer, and of course,
I'm there right now.
Well, I'm shocked.
I knew.
Why did we know that?
I knew that.
I mean, Jurrien, should we slide into the Dutch Caribbean Securities Exchange? I mean, is Will Danoff looking at every stock in there?
Yeah, well, it's Carnival week in Aruba, and that can only mean one thing, and that is that I've got about a dozen extended Timmer family and friends at my brother's house, and that means I get to cook. So I cooked for 12 people last night. I'm cooking for 15 tonight. So this is our annual tradition, and
good for you.
And this is my home island, of course.
We got to know,
Carnival.
Is Abby Johnson ever graced the Timmer household in Aruba for this festivities?
Not that I know of, but if she calls me, I would certainly make some room.
Very good. Jurrien, we appreciate your work. I can't say enough, folks. Literally, a reason to get on LinkedIn is to see the brilliance of Fidelity and Jurrien Timmer there as well. Twitter as well. Jurrien Timmer driving everything in charts, technical analysis and macro analysis at Fidelity.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.